Welcome to our latest episode of the Investing Advice Roundtable. Before we dive into our topic, I know I am personally just sick of this winter weather. So, what are you looking forward to the most this summer?
Larry, want to go first?
Sure, yeah. I mean, I love warm weather, so I'm excited about a lot of things. Pool, golf, trips, just kind of all just getting out, having a couple beverages, that kind of stuff.
Yeah, I agree. I'm really ready for golf season. So far, we haven't been able to do any golfing because there's been snow on the ground for the last 3 months. So that'll be awesome.
Yeah.
So, I would love to golf, but that looks like that takes skill. Anyway, so I don't do that. But I'm ready to open the pool up, and I know my kids are excited about the warm weather. I love the summer, but I'm also just equally excited when they go back to school. So mixed feelings. Okay, so today we are going to be doing something a little bit different. So Elise, do you want to explain this for everyone that's watching?
Yeah, so as financial advisors, we hear a lot of crazy things, especially myths people have about the world of investments. And today it's time to set the record straight and debunk the most common myths about investing. So let's get started. Larry, what is the most common myth you have heard since becoming an advisor?
I think the most common one I've heard is the stock market's like gambling at a casino. I get it if you're picking one stock and seeing if it'll go up or down that day, versus like betting on one roll at the roulette wheel, betting like black or red. Then it's kind of a little similar, but really they're kind of the opposite though when you think about it. At a casino, the longer you gamble, the greater the odds of walking away a loser. The casino always has better odds. It's just math. But in the stock market, the longer you invest, the greater your odds of success. In fact, from 1950 to 2022, the annual returns for a 20-year rolling time frame were anywhere from 6% at the lows to 17% at the highs. So no losses there for long-term investors. Another one is the more stocks you own, the more diversified your portfolio will be. This is true to a certain extent, but it's really how correlated the stocks are to each other. So really how differently they react to market conditions. Correlated stocks tend to move up and down together, while uncorrelated stocks tend to move in opposite directions. For example, if you own a bunch of high growth tech stocks, that's not very diversified. It might be good for returns in an environment that favors tech, but also very risky to have all your eggs in one basket. The key is to have a diversified portfolio across multiple asset classes like stocks, bonds, alternative investments, etc. So you have opportunities to make money in most environments. Holly, what are some common myths you've heard of?
And the one that I'm hearing more right now is it's just easier, it's more convenient, it's better, however you want to define this, to use just an investing app such as like Robinhood instead of going through a financial advisor. And I will be the first to say that yes, it is probably a lot more convenient, and I do like convenience to use these investment apps, but that's the only advantage that I can think of. So these apps, they do not tell you the tax consequences or guide you about tax harvesting or wash sales. And a big difference is normally your financial advisor, they're going to develop financial plans for you. You're not going to get that from any type of app that you use. And an app's not going to guide you in how to invest, which is something that financial advisors obviously will do. And so again, although these apps may be convenient in the long run, if you're not absolutely proficient in taxes or wealth management, then I would definitely recommend seeking advice from a financial advisor. And then another one that I hear quite a bit from just my prospective clients is you have to be rich to even go and talk to a financial advisor. And this is definitely something that I want to just say that it's absolutely not true. I mean, it's our goals to help you set financial goals to achieve no matter what stage you are in your finances, whether that be fresh out of college or even near retirement. We accept all types of accounts, whether it be small to large. So at least those are my two myths that I hear about quite a bit. what are the myths that you hear about from both your clients and your prospective clients?
So kind of similar to your last myth, Holly, one of the myths I hear a lot from my younger clients is you need a lot of money to start investing. Well, all three of us know that not to be true. We have plenty of clients that started their accounts with just $100 and contribute to it consistently. If you don't have a lot to invest right now, consider doing periodic contributions you can afford, anywhere from $50 a month to $500 a month. That way you can take advantage of dollar cost averaging, meaning that no matter what happens to the stock market as it fluctuates, you'll continue to buy into the market and get the benefit of low prices when the market goes down and increased valuation of your stocks when the market goes up. Win-win. Remember this piece of advice: the perfect day to start investing is today. Another myth I think is very important for us to bust today is men make better investors than women. I call BS on that one. Women are equal, if not better, investors to our male counterparts. According to Fidelity's 2021 Women in Investing study, women outperform men by an average of 0.4%, and that can add up to tens of thousands of dollars over a lifetime. So why is that? Women tend to be more thoughtful and disciplined, meaning they are more likely to consistently contribute to accounts. They have a higher level of curiosity, which can lead to more open-mindedness on topics they're unfamiliar with. And similarly, women are more likely to accept advice and collaboration, meaning they're more likely to work with a financial advisor. As we've mentioned before in our video series, your likelihood of successfully saving for retirement drastically increases when you decide to work with an advisor.
Thanks, Holly and Elise, for helping me debunk these investing myths today. I hope we provide our audience with some new knowledge and insights they can use in their own investing journey. We hope you enjoyed this video, and don't forget to subscribe to our YouTube and Spotify for more great content. If you're ready to take our guesswork and work with a financial advisor, our contact information will be at the end of the presentation. Thanks again.